Portfolio Builder's top selling advisor is now up 33% year to date for 2022. And we've been stuck on 3 critical stocks to protect your wealth since early January. And now it's paying out in dividends and likely to continue going higher. Huge catalyst tomorrow for one of our core positions, Boyle. Last year, the high risk growth portfolio returned 233%. 2021, turning every 10,000 into 33,000. Let's jump right into it. Here are the stocks we recommend you own right now based on a $10,000 portfolio. Step 1, buy your crash insurance, UVXY, 69 shares. If stocks tank, UVXY goes up exponentially. It's not like just betting down with an inverted ETF. This is more like buying life insurance. If something really bad and catastrophic happens, it goes up faster than your stocks go down. It's the only insurance policy that makes sense for hedging your portfolio today. And again, in March of 2020, when the world locked down, UVXY went up 1,100%. So if you had 10% of your account just sitting there, the other 90% could have gone to zero. And at the peak panic, you would have had a 10% return. Just a beautiful hedging strategy. Now, UVXY was protecting us during the sell-off this year and did its job. It really reduced volatility for our portfolios. And then as soon as the melt-up occurred, it crashed, but the stocks went up faster than the VIX fell. And our clients are making a lot of money in March. Step 2, buy our favorite growth asset. We like Ethereum, and we like to buy it with the Grayscale Trust stock ticker ETHE. For every $10,000 you're investing, you want to pick up 174 shares. What's important about Ethereum is mainly the user growth. It's growing faster than the internet. Okay, so this is like jumping into Microsoft when it's 5 years old. It's going to take 3 decades for Ethereum to reach peak pricing. Absolutely beautiful time to go long Ethereum currently. And again, ETHE is the Grayscale Trust to put you into that position with your insured stock brokerage account. Don't worry about Coinbase. Just buy ETHE Grayscale Trust, and then you get all the security and don't have to worry about getting hacked. So ETHE is our favorite growth asset. Our favorite value asset or inflation hedge or interest rate hedge currently is natural gas from America, ticker BOIL. Okay, so what's happening right now is tomorrow, RUSSIA, we can't say it out loud, otherwise Big Brother will censor us. They're demanding that the sanctioned currency is used to purchase their natural gas. If Europe doesn't do this, it's lights out. So we're seeing BOIL go right back to the recent high we saw just about a month ago, and I believe it's on the verge of breaking extremely higher. So we're holding on to our BOIL position, even though it's more than doubled. 78 shares of BOIL per 10,000. Here's that chart. This product's wild. It jumps up and down, but the conflict's about to get much more aggressive in the next 2 weeks. That I'm absolutely confident in, and I believe BOIL's going much, much higher than here. So we'll be getting ready to sell BOIL probably in the next 30 days, and then reinvest that into 2 tickers, ETHE, FNGU, and maybe top up UVXY. So we'll go over that in a moment. Here's the current breakdown of your portfolio. Boy, oh boy, UVXY just a few weeks ago was trading at 18% of the portfolio. And as it's fallen in half from 24 to 12, we've racked up a massive return in March of 24%. So just an extreme return with no work. We've literally not touched this portfolio since February. So UVXY is looking attractive at these cheaper levels, expecting the conflict, unfortunately, to escalate this next month. So we may top that up soon. We currently have 174 shares of Ethereum at 48% of the portfolio. That puppy's just been rocketing up. over the last 2 weeks. And then we have 78 shares of Boyle. Now, my expectation is Boyle is going much higher, and we're going to want to sell it in less than 30 days, probably in less than 2 weeks. I think we're about to see Donbass get aggressively attacked here in the next 2 weeks, and potentially some funny business with energy being cut off to Europe. Which is going to be very, very scary time for Europeans. Now, if I'm wrong and the conflict ends, sanctions are gone, I think there's zero chance. I do not see sanctions being removed, period, this year. We'd want to quickly dump UVXY and Boyle, and then add to ETHE and FNGU. And the reason why is if the sanctions are reversed, energy costs come down, inflation expectations fall, and bond yields fall ahead of a slowing global economy. And that's going to make technology stocks skyrocket. So again, we like Ethereum the most. If you bought this 5 years ago, you're up 24,000%, but you're early in the game. Ethereum is growing user base faster than Bitcoin and faster than the internet. Okay, so you're super early. This is our favorite growth asset over the next 3 decades. The second play is FNGU. It has 12 tech companies, leverage times 3, that are red hot. They have monopolies in their market, and they have extreme call option buying via retail. Okay, so I'm actually expecting FNGU to give ETHE a really good run for its money as soon as these energy costs come down. I think we got about 30 days, hopefully, before these energy costs start to cool off and diplomacy reaches Europe. And again, end of conflict means lower inflation, falling yields, crypto, technology melt up. So while we've made a lot of money for clients in the last year and a half being long oil and natural gas, we're expecting the exact opposite to be your best performing asset over the next 9 months. Okay, so I think we've got about 30 days to call a top in oil and natural gas, and then get out of the way and bet big on a technology crypto melt up. Here's the TLT. It's at 131. I'm perfectly fine with the TLT at that level. It's now priced in massive amounts of rate hikes. It's priced in the conflict in Europe, creating sticky energy and food inflation, probably for the next food for at least the next 2 years, energy costs probably for the next month at this $100 plus oil. Then I think it will fall below that for a short period of time. All of that's priced in to the TLT. So as long as we stay above 125, we're going to pretty much be very, very stubborn about our trading plan for the rest of the year. If it breaks below that level, I will get concerned and we will totally change course. So we're watching that. But today, TLT is getting a bid. 2-year bond keeps going up. Half the yield curve's inverted. But you need to know right after a yield curve inversion, the average return on stocks over the next 12 months is a massive 28% return. So absolutely no reason to freak out about the yield curve inverting. In fact, it's really good news to expect extreme returns exactly how we're positioned. And we've been racking up these profits with the dollar going up. In general, with twin deficits, Biden's pushing a $5.8 trillion spending package. Meanwhile, our trade deficit hit a new record high, and people are starting to do trade outside of the dollar. So this all points to a lower dollar. So if you think we're making good money this month with DXY going up, wait till the dollar falls to 90 or 80 or 70, and then you can see some extreme returns hitting our portfolio. Now, the last time the US went into a tightening cycle, 2016 to 2018, China's real estate market had nearly collapsed in 2015. So they had to start printing money aggressively while the US tightened. Sounds a lot like right now, right? We've just had Evergrande, all sorts of real estate companies go bust and bankrupt in China. And now they're putting on the printing press as US tightening. This returned 4,400% in very similar situation, 2016 to 2018. Okay, so we're actually expecting a very similar market setup in the near term. Now, the inflation of 2016 was far lower than today, but perhaps that makes us even more bullish because it means the bond market's just going to be an ugly bet for quite some time. Ashok says, do you expect FNGU to come down? As soon as the energy starts to fall, FNGU is going to rocket ship higher. So we're going to try to call the top as best as we can, Ashok, for you on that one. But for now, cash is trash, bonds are garbage. Okay, governments are printing money to fund the government, and inflation is far higher than bond interest rates. Until those start to match up, investors continue to have no other logical options. We've been beating this drum over and over and over again, and now you're seeing this play out for your portfolio. Stocks, cryptocurrencies, and commodities are likely to melt up until bonds become attractive again. Okay, so we've been playing the commodity side aggressively for the last year and a half. Now I think you need to switch gears, expect for the opposite to outperform. That means crypto and technology companies. Now, again, our main problem with this trading plan will be the second the inflation rate catches up to bond yields. Okay, so the longer this conflict in Europe goes on, the longer we want to stay positioned how we are, because inflation will remain sticky and keep bonds unattractive. So reminder, every Monday, Wednesday, Friday, you should join our live webinar so I can update you on what's happening and what we're expecting to be the current trade alert plan. And most importantly, get that sell alert. Now, if you're on a free trial, you need to upgrade by calling Dean at 505-322-7515. That way you don't miss out on any trade alerts, and you're going to gain access to the membership area where you get the exact trading plan. Now, remember, we have two products, the Safe Growth, which is where we recommend putting 70% of your capital. You can just punch in how much money you want to invest right here, and it'll automatically calculate how many shares to buy. And then below is the high risk portfolio. Again, punch in how much money you want to invest, and it will tell you exactly how many shares to buy. Now, our Safe Growth portfolio just jumped to a 3% return for March, and our high risk portfolio is at 24.7%. And that's fighting a strong dollar. I'm telling you, we're positioned for a weak dollar. If you're doing the 70-30 combo, you're now up 12% year to date in a market where almost everyone is down on the year. Okay, so now we're going to look at some news and data. Tomorrow's the big day where Europe has to start paying for natural gas in the ruble. If they don't, expect oil to go right up and for lights out in Europe. So very interesting. We'll see what decisions they make, but the ruble's now above the value it was before the conflict. So everything we're doing is backfiring, unfortunately. A lot of talk about Mr. Hunter recently. Two different narratives happening. One is that they're trying to push Biden out by 2024. The other narrative is that the Chinese are pressuring Biden not to essentially sanction China as they pick up oil at a 30% discount from Mr. P over in RUSSIA. So very, very interesting. My expectation is Ukraine will have to surrender and come to some diplomacy, and probably within the next 30 to 60 days maximum. So that's about how long I expect us to be holding oil before we rotate into tech. Here's the inflation coming out of Spain and Germany, 7.3 and 9.8. So again, this was the perfect time to make this conflict occur, as inflation's so expensive for the entire world. Pippa Malmgren says, what if this was not a miscalculation? What if the intention was to essentially gain control over more natural gas and drive energy costs higher? So that does seem to be what his plan was. Bloomberg says the inflation this year will cost the average household an additional $433 per month. This almost nearly guarantees a split government after midterms, which may mean a little bit of a slowdown in spending for the US. Now we'll see. These guys do seem to be pretty good at ensuring that the spending per year grows. 2008, 3 trillion a year. Today we're at 6 trillion. And the population growth over that period is tiny. So we've doubled our government spending while not increasing the population. Europe's holding emergency meetings about how they're going to get this natural gas and avoid all the sanctions we've put out, which again, Russia is taking full advantage of. Energy inventories are falling to very scary levels globally. China's been preparing for this for the last 2 years, stockpiling food and energy products. They now have hoarded the world's supply of this and are fully prepared for this crisis. Here's a look at natural gas being drained out of the US. Now, a lot of talk of an imminent recession. I'm not seeing any data to predict a recession this year. There's just so much money still circulating. We've got 10 million jobs open, only 5 million people looking for a job. We've got wages rising, and we've got the government still planning to spend $5.8 trillion. So I don't see any problems for the stock market in the near term. Germany's now gone into a stage 1 of a potential 3-stage gas supply emergency. That's why you see oil running up. But again, the real move in oil could be coming in the next few weeks. So we'll be looking to take profits and reallocate. Now, the one yield curve that's not inverted is the 3-month over the 10-year. And so that's the main argument happening with this whole yield curve discussion, is that most of the yield curve is inverted, but not the super short end against the 10-year. And again, I'm not seeing any data to make me think earnings are about to collapse for corporations at all. Okay, so Thursday's a big day to start taking ruble payments. We'll see how quickly that transition occurs. Kyle Bass is pointing out that China keeps doing lockdowns to drive oil costs down and then buy up as much as they can, saying that this is a twofold attack to keep inflation high for the US by slowing down supply chains and then create these short-term dips in energy costs so they can buy as much as possible. The last 4 times the 2 and 10-year yield curve inverted, the S&P 500 was up 28.8% before peak. Now, why? Okay, it's because the bond market becomes so unattractive that investors are forced into other assets. And so if the Fed wants to hike 50 basis points every meeting and start dumping $1 trillion of debt into the market, as the US has to raise trillions, it's not a good bet to be buying bonds right now. So where do you put your money? Not in cash. We're running massive deficits. So you end up with 2 choices: tech stocks, commodities. And again, we put cryptocurrencies in the tech spot. Jeffrey Gunlax says the treasury yield curve spread is now inverted on the 2-year and 10-year, the 3 and the 5. And right on cue, it doesn't matter this time. White papers are coming out. Don't believe them. Lots of talk of a cyber attack hitting the US. So some of the rumor mongering has been chemical attack, biological attack, nuclear attack, cyber attack. So we'll see if any of that plays out. One of the worst bond crashes in history, down 18%, and it's been going on in a bear market for almost 2 years now. So I think we have potentially another 12 to 24 months before we want to go long bonds, which is when we think inflation will be coming down and yields will be peaking essentially. Okay, I'm going to take a look at the chat. Sean says, what I think about, well, Gunlack's predicting stocks go up until May, and he's worried about a pullback if they do quantitative tightening and rate hikes simultaneously in May. Now, what the Fed's been doing is doing a lot of talk and then delivering a lot less walk. So we'll see what exactly they put to the table in May. But yeah, if bonds crash too hard relative to inflation, I would buy bonds, and that would be our main change. At this point, ahead of midterms, I don't anticipate, unless they're really just saying, screw it, let's crash the whole economy into midterms as Republicans take part of the House and then force them into a lot of stimulus. Would be the only reason I would think that potentially they do quantitative tightening and 50 basis point rate hikes at the same time starting in May. Okay, so I think that's really the big picture. We just need to stay tight. Exact positioning is great. Here's a look at that bond market crashing. This is why the Federal Reserve is really in a pickle. If these interest rates go much higher, it will cause problems. And to be clear, I do not think the global economy can handle the 30-year going much above 2.6. If it goes above 2.6, anticipate our portfolio buying treasuries, expecting this to crash markets. In general, I believe we've peaked at interest rates for this year, and we'll see them trade sideways or down until a lot more stimulus is passed. So that's my expectation, and if so, we won't change positioning anytime soon. Outside of selling Boyle, maybe tapping up UVXY, and then going big on FNGU and ETHE for high risk. If you're in the safe growth, our favorite plays are the triple Q and GBTC. Okay, so here's the 2 and 10-year inverting. Again, this is predicting a recession 12 to 24 months from now. Very bullish in the short term. Here's your ugly yield curve. You can see the 3, 5, and 7-year trade above the 10-year. This is the probability of rate hikes. Almost certainly we'll see a 50 basis point rate hike in May. And I think they're going to delay quantitative tightening. I think that'll be the way they try to soft land these rate hikes is, again, talk up super hawkish policy and then deliver a little less. So far, that's worked really well for markets. This is the VIX futures term structure. This is what we're trading with UVXY. Just so everyone understands, for UVXY to go up, the front month needs to trade at a higher price than the upcoming month. So right now we're in not the right setup for UVXY to go up. And again, we keep a close eye on this to see where the market's hedging the most. And right now there's not a whole lot of hedging. The VIX was smashed as stocks went rocketing up over the last few weeks. Next chart, we look at reverse repo. This is a buffer for quantitative easing. So we've still got $1.78 trillion in reverse repo that could flood into markets at any time, which is a bullish indicator. Now in this chart, we're looking at our 3 favorite cryptocurrencies, Bitcoin, Ethereum, and Polygon. And so we're starting to see Polygon take off. In general, what we see is Bitcoin move first, then Ethereum, and then all the smaller coins. And so that's exactly what's taking place right now. In our safe growth portfolio, we're long GBTC to have exposure to Bitcoin, really the safest bet in crypto. In our high risk portfolio, we're betting on a more aggressive Ethereum with ETHE. Now, if you do become a paid member and join our private equity offering, you can gain exposure to Polygon, which there's no easy way to buy that cryptocurrency. Now, if you know what the Lightning Network is for Bitcoin, that's what Polygon is for Ethereum. Its market cap's about 1/30th that of Ethereum and can have some extreme returns. If I zoom out a little bit, you can see just how much extreme the returns are in Polygon compared to Ethereum, compared to Bitcoin. From this point in time, just going back to August of 2020, you had a peak return of 18,000% in Polygon, 795% in Ethereum, and 313% in Bitcoin. Next chart we're looking at is the Tesla to Ethereum comparison. And we're just looking at divergences. This is telling us perhaps Ethereum has a huge gap up coming to catch up to Tesla. And again, these have traded very correlated over time. Not exact, but they've certainly given us a cue of market direction. And at this point, you can see a 2 times outperformance in Tesla relative to Ethereum at this moment in time. Here's the TLT. In general, as debt grows, interest rates must fall. We're at $300 trillion in global debt. And that's the main reason why we believe if the TLT goes too low, financial markets will crack. It'll act as a black hole and suck up everything around it. And so in general, I do not believe the TLT can go below 120 without crashing global markets. And so if we go to 125, expect us to start getting very hedged on UVXY, reducing exposure to our inflationary assets and starting to build into the TLT. Now we would use TMF to get free leverage. I don't see it happening. I believe everything we know currently in terms of sticky inflation and energy and food, plus all these rate hikes coming down the pipeline, are already priced into the 131 TLT we're trading at today. So unless there's a new surprise, which would probably be natural gas skyrocketing up, oil skyrocketing up due to really serious sanctions on RUSSIA, which is, it's not happening yet. We still have India, China gobbling up as much oil as they can at a discount. If that's cut off and we get a real energy shock, then we could see the TLT go even lower, which would be awful because that's supposed to be your safe haven asset. And we might be entering a conflict war regime with your safe haven asset being attacked due to energy inflation. So very tough market if you're doing the old risk parity strategy of bonds and stocks, which we are not. This chart we're looking at NRGU and BOIL, our 2 favorite plays on inflation. So we played NRGU last year and sold it early this year for a huge gain, and then rotated into BOIL. And BOIL's been keeping up as of recently, and I do believe it has an opportunity to greatly outperform in the next 30 days. So I do expect us to be selling BOIL at some point in April. In this chart, we're looking at lumber futures compared to oil. Last year in May, lumber futures crashed from 1,600 down to 400 and predicted a slow period in oil. Okay, so now lumber futures have ramped right back up and are trading quite correlated with oil. It's acting a little soft, but it's still retraced half of its losses. So no reason to think we're going to get a huge crash in oil right now, especially until these sanctions are reversed. And again, it looks very unlikely any sanctions will be reversed at all. In fact, it seems the plan is, regardless of what happens, to keep these sanctions on now. This chart, we're looking at DXY just to get a feel for how low and high it can go. The .com bust had the dollar up at 120. But then this massive emerging markets rally from 2002 to 2008 drove DXY incredibly from 120 down to 70. Okay, can you imagine what cryptocurrency would do if the dollar fell to 70? So we don't know because the cryptocurrency was invented when the DXY hit 72. In general, the dollar's risen over the entire lifespan of Bitcoin. So we've seen the DXY go from 72 to 97 and to at the same time have 1,000,000% return in Bitcoin. So the setup for the weak dollar is here, and we're really positioned for that. Now, I think over the next 2 years, we'll be seeing it hit 90, and that'll be a chance to do a major rebalancing and take lots of profits on stocks, cryptocurrencies, and commodities, and then to go long essentially the dollar and treasuries. And again, I think that's about 2 years out. Here we're looking at the gold to copper ratio. And right now, not a good read. So we really have gold and copper trading evenly, not predicting interest rates will go up or down. If copper were going up faster than gold, it'd be predicting higher yields. If gold was going up faster than copper, we'd be predicting lower yields. So right now, the Dr. Copper or the gold copper ratio is predicting no change in interest rates. In this chart, we're looking at yellow interest rates, the candlestick tech, and NRGU, we call value or energy. And so in general, what we've seen is quite remarkable. We've had interest rates rising. We've had the value sector or energy sector rising, and we've had the NASDAQ rising. And so that's because we've had Federal Reserve telling the market they're going to crash the bond market with rate hikes for the next 2 years. So again, investors are getting out of the way. No surprise. Now in this chart, we're looking at the Chinese yuan. The only currency that's really been outperforming the dollar is the yuan. And now China is getting ready to expand credit as the US is going to tighten financial conditions. And so they've got a lot of room to do that. Again, this is very bullish for how we're set up currently. In this chart, we're looking at emerging markets compared to the S&P 500 from 2002 to 2008. Okay, so in general, that's essentially what we're seeing over this next cycle is a weakening dollar and an outperformance from Asia, because that's where all the production and efficiency is coming from. The US is printing money, shipping it to China to produce goods and services. And so that's the exact setup that we believe can deliver an outperformance in emerging markets compared to US markets. If you're in the safe growth strategy, you have a large position in EEM with the ETF EDC. Martin says, when you refer to bonds, do you mean all bonds or just US government obligations? Yeah, I would say they're all going to trade very correlated, but we're mostly interested in the biggest market of bonds, which is the US Treasury market, and that drives all interest rates. Now again, emerging markets returned up to 400% in that cycle, while the US stock market only delivered up to 80%. So tremendous outperformance opportunity being long emerging markets. In this chart, we're comparing Alibaba, Tencent, and Taiwan Semiconductors. And we're looking for Alibaba and Tencent to outperform Taiwan Semiconductors to give us a signal that China is ready to stop over-regulating its tech sector and start sending in their buying spree to appreciate technology stocks in China. And we're finally getting that. So if we zoom out, you can see these tech giants were hit hard over the last year as China tried to clean up its economy. And the peak drawdown was 72% on Alibaba. It's made up half of that, or a fourth of that, and it's looking like the bottom's in. So going to be very bullish on emerging markets over the next several years. Here's a look at the European index that we have in our safe growth strategy. It's had a beautiful return, going up as much as 200%, had a nice pullback, and has almost regained all of the conflict losses. So again, when the bombs are dropping and markets are panicking, typically a very good time to buy. That's why we did not freak out. Here's Toyota, one of the key companies in Europe, or Japan, that is, which is part of the index we just looked at. And again, we're looking for weakness in leaders to predict problems for the index. And so while it had a big sell-off, it's regained half of that sell-off and looking very strong once again. Now, it's important to know the chip components of cars are at risk with the conflict in Europe because of neon gas coming out of RUSSIA. So again, this conflict needs to die down in the next 30 days or the inflation story is going to get far worse. Someone's asking if Polygon could go to the same price range of Ethereum. No. But it can greatly outperform it on a percent change. Yeah, I would never expect Polygon to be anywhere near the value. Right now, it's 1/30th the value of Ethereum. If you could cut it down to 1/10th, you're still making 3 times the return on Polygon that you are Ethereum. And I think that might be a realistic ratio. Russell 2000, we're looking at for weakness in the underbelly of the stock market. And so far, it's regaining those losses it had at the start of the year. In this chart, we're looking at some alternative energy products outside of oil and oil, or natural gas and oil. Rare earth metals, RAMX, creates lithium and cobalt, bunch of Chinese mining companies. Your favorites like Tesla and Apple are going to be having huge problems, most likely in 2 to 3 years, getting enough of those two materials. So we like rare earth metals to hedge our tech stocks specifically. Uranium is the most cost-efficient way to produce energy and probably the only chance to get carbon emissions much lower by 2050. So we like both those plays. We've been in copper miners before, but we prefer RAMX over copper miners as we head into a very tech-heavy decade ahead. So RAMX, we see ourselves holding very long-term. Only thing that scared me out of that would be if US and China started to get in a big conflict. And again, that might be why we're suddenly seeing all this stuff surface about Hunter to pressure US not to start sanctioning US. And again, they could cripple Apple in a heartbeat. So I don't see the US getting too aggressive on that front anytime soon. This chart, we're looking at divergences in gold and silver as a potential play. At this point, I don't see stagflation. I see a red hot economy. I see 10 million jobs. I see fast growing credit. So I don't see a real reason to bet big on gold or silver currently, but we're keeping a close eye on it, and it has had a remarkable return as of recently. Core inflation, this is really the most important data over the next 6 months. My expectation is the core inflation rate will trade below 7 in March, which we'll get in April. So in a few weeks, we'll get the new print. This is the inflation that excludes food and energy. The food and energy one traded at 7.9. I believe it may pop up to 9 to 10%. And again, I believe the bond market's already priced this in, and it's already priced in the inflation being sticky for a few months. Now, again, I don't think it's priced in this lasting over 3 months. So I think we can withstand sticky high levels of inflation that are slowly pulling back after the March print. But after that, I do think the bond market would get quite upset. So for now, we're staying put. Non-farm payrolls had a big print. They keep manipulating these numbers, but I believe we're on the course for very strong jobs growth this year. Labor force is going straight up, so that's pretty impressive. We're still way below the lockdown era, but this is what would really drive inflation beyond a year or two, which is what I'm currently believing is the maximum time we'll see high levels of inflation. Now, to really get a decade of labor force participation rising, we'd have to decouple from China, and the corporations really don't want that. So I find that highly unlikely currently, but we'll see how that plays out after the midterms with potentially different people in control of the government. Bank credit continues to grow. Consumer credit continues to grow. wage pressure, retail sales continues to grow, just to hit a new consumer spending record in the US. There's really no signs of a dying economy currently in the US. And again, it's all fueled by debt. Trade balance hit a new record high, so we're importing far more than we're exporting as we run massive government deficits. Over time, this does hurt the value of the dollar. New home sales still red hot. All this talk of a crashing real estate market, not happening. Okay, the average home price now over $500,000, and the inventory is extremely low. Okay, now interest rates have risen sharp, up to 4.5%. But again, we're not seeing crashing home prices or new home sales. And if we go back to the 2008 financial crisis, interest rates peaked in 2016. It took a full 2 years to turn into a huge crash in markets. China's imports and exports remain very strong. The US has stopped printing money. Okay, but Japan is now buying an unlimited amount of its debt, and China is ramping up spending, and probably Europe's going to have to ramp up its spending to deal with this conflict in Europe. So I do not forecast us changing our trading plan anytime soon. Okay, very good. So we're keeping it short and simple today. This is where your video ends if you're not a paid member. And again, if you want to get the sell alert, we're going to be selling BOIL at the perfect time, hopefully, as best we can get. I do expect things to get worse in the conflict in Europe over the next 2 weeks, and for us to start selling BOIL and reallocating that into topping up UVXY and going more aggressive in tech stocks. So call Dean so you don't miss out on the next trade alert at 505-322-7515.